market mistakes and how to minimize them. Phil's gang has successfully taught tens of thousands of investors how to navigate the market with confidence. You don't need to be a seasoned investor to benefit from the Phil's Gang platform, no matter what level of investor you are. Phil's Gang strategies for investing are designed to put you on the path to success. Sign up for a 10-day free trial to see our platform in action, avoid market pitfalls, and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com. Want the truth when investing in the stock market? Here's how.
Hi, I'm Phil Grande at philsgang.com. Listen to my radio show every day because that's where you're going to get the truth. You're not going to get the truth listening to these dopes on Fake Business News Network. The other day, Kramer said, don't listen to the banks. They're giving you wrong information. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
And welcome. Okay, you can see volatility in the markets getting worse. Now, as I said, I don't expect any kind of correction in the stock market until the first or second quarter, okay, of 2026. Because remember, to have a crash, it's like, it takes time. It's like turning to Queen Mary with a canoe. It's really timely, it's a lot of work. But we are heading that way. Now, I don't want you to get mad at me and throw stones at me because anytime you mention a possible crash, people really get upset with you. But we're going to have a crash. I mean, you can see it. The bond market's telling us we're going to have a crash. Remember, it's not my opinion. It's the opinion of the bond market. The bond market is a terrific place because you get good information from the bond market as to what is the market going to do. When people ask me, well, are we going to have a crash? When will it occur? I said, well, the bond market will tell us. It's never a secret. The problem is the people you see on these TV shows, the jibber jabbers, they're not going to tell you because they want you to buy all the time. They're not going to tell you. But what you're seeing today is, again, real volatility. Now, if you remember, I told you going back, and it was back in January of this year, early January, I said the tech companies, the big boys, I'm not the tech companies, the big institutions who make up 70% of the volume during the day. These are your 401ks, your hedge funds, your wealth managers, your biggest banks, the biggest guys who really control the market. You follow them, and you're always going to be right. You follow the bond market, you're always going to be right. Now, if you remember back then, I said they felt that these AI stocks are a big bubble. They pointed out that when you look at, for example, we just got this the other day, and they're right about it, that they are already, or let me back up. As you know, there's been a lot of press about how these AI stocks are just over their head, meaning that the returns that you get on these stocks are terrible. And we're seeing that. In a minute that starts coming up and it starts coming out, they mask it right away. They stop it. They don't want you to hear that. But what we're starting to see, all of a sudden we're starting to see more transparency. Example, we saw just today, they were talking about how all these AI stocks that need data centers, they have to power them up. They're borrowing tremendous amount of money on leverage. Most of them don't have the money for it, but they're leveraging it. They're borrowing anyways because they're saying that not to worry because they'll do the same thing that Obama did with Solandra. In the end, they'll go to the president like they did went to Obama and ask him to bail him out. And that's what they're talking about, because they got to get their data centers have to get up and running, and they need to power them up, and that costs a fortune. So they're in over their heads, and they're saying, we don't mind if we get a lot of debt, because the president won't, just like Obama won't let the solar panel technology go down. They're not going to let AI go down, and we'll get a bailout from the government, just like Obama bailed out Solandra and finally went down and we lost billions of dollars. Well, that is going on in the background. That's why one reason why you're starting to see these AI stocks not recovering as fast as they used to. The other problem you're seeing with these AI stocks not recovering, because the FOMOs, remember what happened going back in January, April. So let's go forward from January to April. So January, they made an announcement, big institutions, they were not going to continue to buy these AI stocks. They're going to cut way back. And then when they got into April, they got a big margin call, because we were told that the tariffs, even at 10 to 18%, will not affect the economy, will not affect individuals, will not affect business. It's a no-brainer. There's no burger there, no meat there, not to worry about it. Well, there turned to be a lot of meat there, because a lot of the companies, let's see if I can show you if I can get that chart up. Let me see if I got that chart, or is it behind here? Let me find this chart. This is interesting. No, it's not there. Here, let me pull this chart. Yeah, let me see if I can get this chart, because it's quite interesting. It's in the show folder, right? Okay. All right. I think it was this one here, is it? I think it's the right one. I have the right one. Nope. Why don't you pop it up for me, Willie? Find the one that we need for him. Okay, well, he's looking for the folder. So what's happening is this. As I said, when they said back in January that they were not going to be buying as many of these, they're going to cut way back. When April came, all of a sudden they had a big margin call, because everyone said there's not going to, you got it up? Everyone's saying not to worry. There's not going to be a problem with these tariffs at 10 to 18%. Well, all of a sudden, the big hedge funds, the big guys, got hit with massive margin calls, because companies were that they were invested in were getting hit hard because of these tariffs that we were told is not going to happen. If you look in this chart and look at the different recreational stocks they're involved with, leisure stocks like hotels and restaurants, they were tanking, and they were losing money, and they were tanking. You see it on the chart, because of these tariffs that they said would never affect us. In fact, the other day we talked about how Trump came out and said he's going to put a program together to give every family in the United States $2,000 because of how they got hit hard because of these tariffs, which contradicted, oh, no, nobody's going to get hurt. So what they did, remember, the big institutions, especially the big hedge funds, when April came and they got hit with these margin calls because of tariffs, they started to dump what AI stocks they had to raise money to pay their margin debt. In the meantime, we're not seeing those AI tech stocks going down every day. New highs, new highs, new highs, because we're seeing what? We're seeing the FOMOs, or I call them tourist investors, don't know what they're doing. Every time one of these tech stocks would go down, they'd go in and buy it. They had no money, so they were buying on margin. So the Fed made sure we kept increasing our money supply so there'd be enough money in margin accounts on Wall Street to make sure that the FOMOs, the tourist investors, because they don't have any money themselves, could buy on credit. So they could mask what was really going on in these stocks, in these AI stocks. So that's why we didn't see it for a while until recently. Now what happens? Everyone starts talking about, okay, we got a problem here. These investors are putting in millions and millions and trillions and billions of dollars. They're getting no returns. And every time they'd come out with an article or somebody on CNBC would say that, the next day they would mask it with a glowing report about AI. They kept trying to mask it. Well, they couldn't keep masking it. So now, at the same time, you got in this corner, the AI stocks have noise going on. The returns aren't big enough for the investors. You got a major selling going on that's been masked by the FOMOs going in and buying on margin debt. And who did that? Okay, Wall Street arranged that with of course, with the Fed, who they control, so that nobody would panic on these AI stocks. And so that's been masked for a long time. So now what happens? Now we find out that the QT that Powell has been doing, okay, since 2022, to fight the QE inflation, that's starting to fall apart. Because remember, when you do QT, the tightening, you're pulling out billions and billions of dollars. You're taking out that money supply. And remember, you're pulling the money supply out out of the system. You're pulling the money supply out of the economy. And at the same time, what they do is they sell treasuries. They're dumping their treasuries, $60 billion a month. So when you keep dumping those treasuries, all of a sudden, too, what happens is the dollar. The dollar starts getting hammered. So eventually, as they dump that $60 billion a month, yields start going up. So yields rise because of that dollar demand. Now remember, QT takes the dollars out of the system. In October, there was a need for $125 billion to get to the banks. There was an emergency meeting because the banks at night loan to each other. Well, they didn't have any money among themselves to loan to each other. So the Fed had to hurry up and get to all the institutions to get them to put in a pile of money into this big bowl, we'll call it, so they could give the banks money because the banks have no dollars. That's what caused the crash in 2008. But back then in 2008, we didn't have we didn't have a sugar bowl to go to, a cookie jar to go to. So on one side, our banks are in deep trouble right now. And that's why when you see, and I told my gang members to be careful, we're shorting the tech stocks. We just started to buy a little bit of the banks because they're starting to shift money to the banks. Now, most of the money is going into healthcare because that's where, we see most of the money going into healthcare. But money is going into the banks away from these tech stocks. But the problem right now is that this QT that he's going to stop in December can be a real problem.
2 minutes.
Because QT, again, the reason we do QT is to curb inflation caused by QE, and it's done by selling these treasuries, $60 billion a month, in turn reduces the money supply, in turn puts demand on people want dollars, so yields start going up. And when you start getting this, everybody's looking for dollars. The banks need dollars. We saw that. The dollar increases, right? The purchasing power. So again, Powell's saying, I got to stop QT now. And we took enough money out when that's a big mistake. Because remember, he did QE to stop inflation. We have not hit the target inflation at 2%.
1 minute.
So the problem becomes he has no pathway to fix this. And that's why you're going to have a crash. Because remember, China, Japan, and UK are not buying our treasuries. He's thinking, okay, I'm going to stop QT, and I'm going to take and lower my Fed short-term rate. I'm going to drop it down as close to zero as I can, get that down there, and then it's going to drive the 10-year Treasury yield down. Because once they see me in there with my short-term Fed rate, cutting rates, China, Japan, and UK will come back and buy treasuries. They're not buying treasuries. They're not coming back. They're buying gold because they know they're looking at our deficits. They're looking at our debt. They don't want to have anything to do with lending us money. When they sell us goods and they get their dollars, they're running right to gold.
7, 6.
So what's going to be interesting in this rotation is you really got to watch it carefully because we'll get one more rally. But you really got to watch these AI stocks and you got to watch these bank stuff.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grande and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, or you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now that can be really expensive, cost thousands of dollars. But I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro, Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
Welcome back to the Phil's Gang Radio Show. Want to know more about Phil's Gang? Go to philsgang.com or give us a call at 877-600-4264. Now, here's Phil.
And welcome back. So, just to wrap up where we are and where we're going, I've been saying all along, I think we're going to end up having a large correction or crash the first or second quarter of 2026. What we're seeing right now is a very volatile market. We're seeing a rotation, and we are seeing, I mean, it could happen before that. And what we're seeing is the FOMOs are not jumping back in right now and buying the AI stocks as quickly as they were because they're in debt. And what's happening, the prices of these stocks are starting to drop, and the CEOs of these companies aren't going to do stock buybacks because they're in debt big time. And so what's going to happen, remember, in your big hedge funds and your big institutions aren't buying these stocks either. And while these stocks are being sold off, and remember, as I said, if you take and look at many of these stocks were sold off in April when the margin debts had to be covered by the institutions, especially the hedge funds. They had margin debt, and they got called because of remember they were telling us not to worry, that tariffs were not going to affect companies, not going to affect really anybody. Well, that didn't turn out to be true. We knew that. So the tariffs did affect terribly, as I showed you earlier, a lot of these companies. And what happened was the big hedge funds and institutions had a lot of money invested in, for example, restaurants and so forth. And when their stocks got clobbered, they had to meet their margin debt. And so they started to sell off the AI stocks because they made an announcement back in January. Remember, this was April when they got hit with the margin call, but back in January they announced to everybody they were no longer going to be big buyers of AI because they see problems with AI. One, they see the problem, for example, that these AI stocks, they need to get their data centers powered up to work, to get going, and they don't have the money for that. So they're borrowing on very heavily, very leveraged. And so, because they don't have the money, but they're counting on the government to come in and to do what they did with Solandra. The government come in and bail them out, either be their partner or just give them the money, subsidize them. That's what they're thinking. So right now, that's one problem that they saw back in April. The big institutions, especially the hedge funds, they said, well, that's a big problem. We don't want anything to do with that. And then they also knew back then, they realized that all the money they're investing in these stocks, these AI stocks, the returns were going to be nothing. The returns are terrible. Then we find out this week they are masking their numbers. Their profits are better than what they really are because what they're doing is not going by the accepted accounting rules in this country. Everybody has the same accounting rules, GAAP. They decided they're no longer going to depreciate. Use depreciation. So we got one problem early on in December of 2025 and January 2026 that they're not getting the returns they need. That's one big problem, right? And of course, the second problem, they're borrowing this tremendous amount of money they can't afford, betting they're going to get bailed out, and they're using that to power up their data centers, and when they finally can't pay it, they're saying, well, the government will bail us out. And then third, we're starting to see they're masking and playing games with their profits, and they're saying, just take by 2026, next year this time, you're going to see these companies like Oracle reporting profits 26% more than they actually are because they're not going to use depreciation. Everybody uses depreciation. It's an accounting rule. So if anybody sold the business, you know what I'm talking about. If you sold the business, you said, I'm making $500,000 a year. You say, but I'm really making more than that. Look at my depreciation. I depreciated $100,000. So you got to add that $100,000 back. So I really made $600,000. But that depreciation is real expense, and it brings down your profits. Well, they're not doing that. They're not going along with GAAP rules. So they're seeing more and more problems going on with these stocks, and everybody's just kind of, Wall Street, they're so invested in these, they're masking a lot of it. Now, the problem comes when, remember, we didn't see the S&P go down. We didn't see the NASDAQ go down. with these problems, because every time these stocks dropped, you had the FOMOs, those tourist investors, fear of missing out. They'd immediately buy these stocks when they were dumped. So that's why you didn't see the S&P and the Qs go down. But now you're seeing it. Now it's showing up. Now another problem that's going on is valuations are stretched. The stock prices are higher than the earnings. And the stock prices are not aligning up with the valuation. That's another problem they're seeing. And another big problem we're seeing, AI is killing our jobs. Killing our jobs. Now, they're not showing us our job numbers. They're saying, well, the economy's been closed, but ADP came out the other day, and I think October, we lost 45,000 jobs. So there's a lot of problems going on here. And then you can see in the market, if you look at your growth stocks, which are your tech stocks, like NVIDIA, look at NVIDIA. I got them up here for you. You can see NVIDIA. Look how it's breaking down. It's ready to break its 50-day moving average support. Now they're rotating out NVIDIA and they're buying JP Morgan, the banks. But even the banks are starting to pull back. Even the banks are pulling back, but not like what's going on with NVIDIA. NVIDIA is ready to break the 50-day moving average. And so then take a look at Meta. Meta's getting really crushed. But then if you look at, for example, Citibank is doing pretty well. It's got relative strength today with the Dow down 851 points and the S&P down 125. Pretty strong. So the banks, they're starting to move money to the banks. If you look at the Morgan Stanley, doing pretty well. Doing much better than Microsoft. Now, we haven't seen this before because the FOMOs would come right in and buy these. Couldn't wait to buy them, but they can't now because what's happening is with prices going, they're getting margin calls that they didn't get before. So that's a problem. That's been pushing these stocks up. Not the institutions. They haven't been buying them because they're worried about the returns, too much investment, no returns. They're worried about, again, what's going on with this, the mess they got with they're not doing depreciation, which goes against all the accounting rules. And they're worried, they said by 2028, if they keep doing this, the bubble's going to be huge, bigger than 2008, because they're not depreciating. Now, on top of all this, you go in and take a look at what our idiot friend is doing, Powell, I shouldn't say that about him, but the Fed has never done anything right. We got to get rid of the Fed. He's now made so many mistakes, he has no pathway out of this. What am I talking about? So, when he allowed Biden to run inflation up to 9%, because they're pushing up these, because again, remember we had tremendous inflation because what were they doing? They kept on, we had QE. QE, you keep printing and printing and printing, and then you take that money and you give it to the Fed, and the Fed takes that money, and they buy treasuries, or they give it to the banks, and the banks buy treasury to try to bring the 10-year yield down. If they get that 10-year yield down, then China, Japan, and the UK will buy our bonds. So what's been happening is China, Japan, and UK aren't buying our bonds. They've been buying gold because they can see what's going on. We got a problem here. Not only is the problem that Oracle's earnings or profits going to be 26% more than they should be, but they're saying, why should we buy? Why should China, Japan, and UK purchase our treasuries to drive down the yields for Powell? Why would we do that? Because in the last 11 months, remember, they've been dumping $81 billion of their treasuries. These three China, Japan, and UK. Why would they buy when they're dumping 81 billion? They're now holding just 759 billion, and that's the lowest number since 2009. So Powell thinking that he's going to stop QT, and he's going to turn around. Okay, he's going to stop QT, and he's going to lower his Fed rate, and the Fed rate's going to take the 10-year Treasury and drop, and that because he lowers his Fed rate, it will influence the 10-year Treasury to drop down below 3%. And he's saying then they're going to come in and China, Japan, and UK will buy our Treasuries. No, they're not. Why would they? They're not going to buy them because they know he can't get down below 4%. He may hit 3.9, he may hit even 3, but that's not where it needs to be. So what they're looking at is saying the yields are going to go the other way. If he does QT, which he's been doing, and he stops QT, that means he's not fighting inflation anymore. And he believes, okay, I'm not going to do QE, but what I'm going to do is drop my Fed rates down, try to get as close to zero, so the 10-year Treasury yields will drop, close, hopefully, to 2%. Then they'll buy my Treasuries, China, Japan, and UK. No, they're not.
3 minutes.
They're not going to do it. And they're not doing it. They're continuing to buy gold. So we got problems on three fronts. Got problems the way they're accounting for these companies, AI companies. They're in debt over their head trying to power up their data systems. They don't have that kind of money, so they're borrowing and borrowing and borrowing to power up their data stations. And they're saying, well, we'll just wait to have the government bail us out. And going off of QT is a danger. Remember, QT is used to curb your inflation, okay, that's caused by QE. Now, they've been dumping $60 billion a month in treasuries, and don't forget, China, Japan, and the UK together have been dumping $80 billion. They dumped $80 billion since October to now. I think I'm right with that, pretty close, I think. So they think, okay, this is reducing the money supply, and that means the dollars in the systems are out, gone. That's why they had to have an emergency and get $25 billion in a pool to give to the banks. If this was 2008, we would have had a big crash. But we learned since 2008, we didn't have a facility, a Fed facility, but we do have one now that you can go to the Fed at last resort, and they'll find investors to put money in the pool to keep the banks alive. The banks don't have any money. You're in trouble. So there's three issues going on. Now, if you take a look at the rotation in stocks right now, what's really worrisome is when you look at stocks like NVIDIA.
About 30 seconds.
When you look at stocks like Meta, they never stayed down like this. They'd go right back up because the FOMOs would be in there buying with their margin debt, but they're getting margin calls. So the one thing we think will happen, we don't know, but remember, the bond market tells you what's going on. The bond market's indicating we're going to get one more big rally. After that rally, and all the big boys are out, they'll pull their bids out, and that's when you'll get the crash. That'll probably happen around the second quarter of 2026. We don't know. But we'll just keep watching the bond market when we get closer to find out when the hell this thing is really going to collapse. So, remember.
Your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.